Welcome to the Deep Dive. Today, we're plunging into something really fascinating, maybe a bit troubling too, in the world of frontier tech.
Right, specifically looking at AI and Web3.
Exactly. We want to understand this weird situation we're calling the high valuation, a low revenue paradigm. You know, how some startups get these huge multi-billion-dollar valuations.
But without much to show for it in terms of like actual revenue or even users.
Yeah, minimal metrics. And we're going to use Story Protocol as our sort of main example today.
Ah, yes, the decentralized IP network.
That's the one. Raised over $130 million, hit a multi-billion valuation, but then faced some, well, pretty sharp criticism.
The revenue claims are pretty wild, weren't they? $24 in revenue yesterday, things like that.
Exactly, and no users. Then co-founder Jason Zhao stepped back from his full-time role. So, okay, let's try and unpack this. How does something like this even happen?
Well, the interesting thing, maybe the core thing here, is that this isn't necessarily a bug. It's kind of a feature of how venture capital works.
A feature? How so?
VC firms, they operate on this thing called the power law of returns. Basically, they need a few massive successes, moonshots they call them, to make up for all the investments that don't pan out.
Ah, okay, so they're betting big on a few potential giants.
Precisely.
Yeah.
And this pushes them to fund really high-risk stuff, sometimes before there's even a product. They often overcapitalize these ventures.
Overcapitalized meaning just giving them way more money than they perhaps need at that stage.
Exactly. Story Protocol's $80 million Series B at that $2.25 billion valuation. That's a classic example of this dynamic in play.
Wow. Okay, so if there's no revenue or very little, how on earth are they valued? It's not PE ratios or anything traditional.
No, definitely not. It's much more qualitative. A strong founding team is huge. You mentioned Jason Zhao, his background at DeepMind, Stanford. That matters a lot.
Credentials. Makes sense.
But honestly, often the biggest factor is the story, the narrative, the pitch deck. How compelling is the vision?
So it really rewards good storytelling, maybe even over like quiet building in the background.
You could definitely argue that. It's about selling the dream, the potential future value.
Okay, that narrative focus. That connects to the founder side of things too, right? Like vesting schedules.
Absolutely. Vesting is supposed to keep founders committed long-term, usually over 4 years. Get your shares gradually.
But it doesn't always work out quite like that.
Well, in this kind of high-pressure, high-valuation environment, it can sometimes feel like a race to the exit. There were criticisms, allegations that Zhao's departure was timed, before vesting renews.
Okay. So how do founders actually lock in wealth before a big exit, like an IPO or acquisition?
That's where OTC deals come in, over-the-counter sales, selling shares privately on secondary markets like Ford Global.
Ah, so they can sell some of their stake early, get liquid.
Exactly. It lets them de-risk their personal situation, transfer that early risk onto new investors, really regardless of whether the company eventually succeeds commercially or not.
That's quite something, transferring the risk like that. Okay, so shifting back to Story Protocol itself, what was the idea, the business model supposed to be?
Theoretically, it's pretty ambitious. A decentralized network for intellectual property built on blockchain.
Okay. What does that mean in practice?
The idea was creators could, tokenize their work, music, art, writing, and then use smart contracts, these royalty modules and royalty tokens, to automatically manage licensing and collect payments whenever their IP is used.
Automated micro-royalties, essentially.
That's the concept, a global automated system. But, well, that ambitious theory crashes pretty hard against that $24 in revenue critique, doesn't it?
It certainly does. And thinking bigger picture, especially in the Web3 space, this makes me think about the term vaporware. Has its meaning sort of shifted?
I think so, yeah. It used to just mean software that was announced but never actually released.
Yeah.
Now, maybe it also includes protocols or platforms that do launch, technically, but just fail to get any real traction. No meaningful adoption, no utility, no revenue, effectively, zero users.
Is this more common in Web3 than, say, AI?
Well, AI's utility is often a bit more direct, easier to grasp immediately. Web3 deals with more abstract concepts, decentralization, tokenomics, these complex economic models for tokens.
Which makes it easier to maybe overhype.
Potentially, yes. It can be more susceptible to projects that have a great story but maybe lack fundamental viability. And the result of this whole paradigm, it's arguably a misallocation of capital, of talent.
And it damages trust, right, in the whole tech sector.
Definitely. It can lead to cynicism and erosion of trust when you see these huge valuations seemingly disconnected from reality.
Okay, so let's try and boil this down. This paradox, huge valuations, tiny revenues, it's not random.
No, it seems like a predictable result of the system. EC incentives prioritize hype, funding rounds, the narrative, sometimes over actually building a sustainable business first.
And founders can potentially achieve significant personal financial success before the product really proves itself in the market.
That's the crux of it. The incentives can allow for personal wins disconnected from market validation.
So this raises a pretty important question then for you listening.
Right. How do you, as someone trying to understand this space, learn to spot genuine innovation versus just, well, flash over substance? How do you identify real sustainable value when it's all wrapped up in these compelling stories?
That's a really powerful thought to leave things on. Thank you for joining us on this deep dive.
Always interesting.
Until next time, keep questioning, keep learning, and keep diving deep.